Think about your own financial life for a moment. If you were to list everything you own, like your laptop or your car, and put it in one column, and then list everything you owe, like a student loan, in another, you'd have a basic snapshot of where you stand. We call what you own your assets, and what you owe your liabilities. If you take the value of those assets and subtract your liabilities, the amount that's left over is your net worth. It's the simple bottom line of what you actually have to your name. When we look at a major institution like a bank, they use these exact same categories to track their money. But the moment we step inside the bank, this financial logic actually flips on its head. When you put your paycheck into a savings account, you see that money as your asset. But to the bank, your deposit is a liability. It's money they owe back to you, and they have to be ready to hand it over the moment you ask for it. This reversal defines how a bank operates. Everything they do is shaped by the fact that their primary source of funding is money they technically owe to someone else. We can see this in the actual data for U.S. commercial banks. If we look at the liability section on this balance sheet, customer deposits make up the vast majority of the bank's funds, more than 85%. To make money, the bank takes those deposits and sends them back out into the broader economy as new loans. If we look at the assets section, the largest category by far is loans. These loans are the bank's assets because the people who borrowed that money now owe it back to the bank with interest. Whether it's a mortgage for a new home or a loan for a local factory, these are the primary ways the bank earns its keep. The bank pays you a low interest rate to keep your deposits, but it charges borrowers a higher rate on their loans. The money left over after the bank pays its depositors is called net interest income. Then there is bank capital. This is what's left when you subtract the bank's liabilities from its assets. It's the institutional version of net worth, the actual stake the owners have in the business. This capital acts as a cushion. If a group of borrowers can't pay back their loans, the bank uses this capital to absorb the loss so that your deposits stay safe. To see how well a bank is managing this process, owners and regulators look at two specific numbers. The first is return on assets, or ROA. This tells us how much profit the bank is squeezing out of every dollar they've lent out. It's a measure of how efficiently the bank is putting its total portfolio to work. The second is return on equity, or ROE. This looks specifically at the owner's stake. It tells the people who invested their own money to start the bank exactly what kind of reward they're getting for the risk they took. But chasing these returns means the bank has to constantly juggle three major risks. First is liquidity risk. This happens when too many depositors want their cash back at the exact same time, while that money is currently tied up in long-term loans. Second is credit risk. This is the simple danger that a borrower's business fails or they lose their job, and the loan just never gets repaid. Finally, there is interest rate risk. If market rates go up, the bank has to pay depositors more to keep them from leaving, but they were still stuck earning the old, lower rates on the loans they handed out years ago. If a bank doesn't manage these risks carefully, it doesn't just lose profit, it can run out of cash entirely. To avoid all of this risk, a bank could technically just take every deposit and lock it away as cash in a vault like this. In that scenario, the bank is perfectly safe, but it earns zero profit. And because that money is just sitting there, families couldn't get mortgages to buy homes, and entrepreneurs couldn't get the credit they need to build new businesses. On the other hand, if the bank lends out every single dollar to chase the highest profit, they are left defenseless the moment a few customers walk in wanting to withdraw their savings. Every day, a bank is performing a high-stakes balancing act. They have to keep enough cash ready to keep you happy, while putting enough money into loans to keep the business alive. When a bank manages this balance correctly, they aren't just storing your savings. They are funneling that capital into the mortgages and business loans that actually build the community around you. This content is for educational purposes only and is created by the University of Utah.